call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nishit Solanki from CDR India. Thank you, and over to you, Mr. Solanki.
Thank you. Good morning, everyone, and welcome to Neogen Chemicals Q2FY25 earnings call for analysts and investors. Today, we are joined by senior members of the management team, including Dr. Harin Kanani, Managing Director, Mr. Anurag Surana, Director, and Mr. Gopi Krishnan Sarathy, Chief Financial Officer. We will commence the call with opening thoughts from the management team, post which we shall open the forum for Q&A, where the management will be addressing queries of the participants. Before we commence, I would like to share a standard disclaimer. Certain statements made or discussed on the conference call today may be forward-looking statements. The actual results may vary from these forward-looking statements. A detailed disclaimer in this regard is available in Neogen Chemicals Q2FY25 earnings presentation, which have been uploaded on the stock exchange website. I would now like to invite Dr. Harin Kanani to share his perspectives. Thank you, and over to you, sir.
Thank you, Nishit. Thank you for joining us for our second quarter earnings call. Season's greeting to everyone. Hope you had a joyous Diwali with your family. Wishing everyone a very happy and prosperous New Year. As you know, we have appointed Mr. Gopi Krishnan Sarathy as the Chief Financial Officer of Neogen Chemicals. We welcome him in the new role and wish him the best. I will be sharing my views on the performance and strategy, while Mr. Gopi Krishnan will take you through the financial highlights. Neogen Chemicals achieved a robust performance during the period under review, demonstrating resilience and strong execution. This came amidst a challenging market landscape characterized by weak demand, oversupply situation, geopolitical tensions, and inflation, which impacted industry's pricing power as well as profitability. The performance was driven by volume gains registered in the base business with additional contributions from BuLi Chemicals and Neogen Ionics. This achievement is a reflection of our team's commitment to excellence, their ability to innovate, and adapt to changing circumstances to deliver results. I will now present a concise summary of the key financial figures for Q2 FY25 on a consolidated basis. Our revenues grew by 20% year-on-year to rupees 193 crore, while EBITDA came in at rupees 35 crore, an increase of 33% year-on-year. This translated to EBITDA margins of 17.9%, an increase of 180 basis points. Profit after tax stood at rupees 11 crore, representing an increase of 30% year-on-year. As informed, Mr. Gopi Krishnan will share more insights on the financial performance. Now shifting your focus to the segment performance. In Q2 FY25, organic revenues reported a growth of 34%, while inorganic revenues declined 24%, mainly contributed by lower lithium prices. Both bromine and lithium raw material prices experienced a steep decline during the period under review as compared to the same period in the prior year. Adjusting for this fall, the organic revenue would have been higher at about 186 crore in Q2 FY25, while the inorganic revenues would have been higher at rupees 55 crore during the same period. I will now provide an update on our expansion activities. New capacity of 400 metric tons per annum for manufacturing lithium electrolyte salts and additives. So here we already commissioned the first 200 metric tons per annum, and initial approval of the material that we have shipped to the customers have already been received, and we will start the volumes in this area will start growing in Q3 and Q4. For the remaining 200 metric tons per annum, trial production and optimization of the processes are currently ongoing. We've already had some customer site visits which have approved the facility, but further more rigorous approval process is currently ongoing. Plant for manufacturing the 2000 metric ton of electrolyte at Dahej facility. We are implementing the phase commissioning strategy here, and in the first phase 200 metric ton has already started, with which we have now approved more than 4 customers at a commercial level, And in Q3 and Q4, as our customers ramp up their self-production volumes, we expect our electrolyte volumes also to get ramped up. Both these will be fully utilized, will be fully online and get approved before the end of current financial year. By closely collaborating with our customers, we have jointly developed and exchanged multiple recipes of electrolytes with different lithium salt combinations. In the process, we also gained valuable insights on the technological capabilities and market trends. We are committed to maintaining stringent quality standards and adhering to strict safety protocols. The positive feedback from our customers validates our commitments to delivering high quality and efficient products. Our business development team has been actively engaged with domestic and international customers, hosting them for on-site inspection and approval visits. About the greenfield battery material facility using MUIS technology, with the financial closure secured, we have already initiated construction and the project is progressing as planned. We have started the civil construction at the site, and our partners Mitsubishi have started the plant construction at their end. So both are meeting the targeted deadlines. We have a dedicated team in place to expedite the completion of the project. Several large battery manufacturers are expected to start operations soon, and we are progressing with long-term contract discussions. We are phasing the commissioning of this facility in FY26 as per our original plan. There's still a strong demand for the non-Chinese products, coupled with ongoing discussions and MOUs which we have, which basically secure the international salt business, which is expected from this site. We believe India's expanding EV industry presents a significant opportunity for the electrolyte markets. The work which Neogen has done both domestically as well as internationally, we are seeing a lot more interest coming both from local as well as international customers. And as a country strives to achieve our ambitions of EV adoption goals, the demand for high quality, locally sourced electrolyte is expected to surge. With the work we have done in last 2 years, we are in the right position to take care of this demand. Consequently, we are committed to making long-term investment to secure our future growth and success. Our growth strategy is focused on scaling up our organic and inorganic chemical business. Also, we are seeing good progress in our CSM business as well. Of course, we are waiting for improvement on the agro demand for the product for this business to develop further. Navigating the current global economic landscape, Neogen Chemical is demonstrating resilience, embracing innovation, and staying focused on delivering value to our stakeholders. That concludes my opening remarks. I would now request our CFO, Mr. Gopi Krishnan Sarathy, to share the financial highlights for the period under review.
Thank you, Dr. Harin. Good morning, everyone, and welcome to Q2FY25 earnings call. I'm delighted to be the part of Neogen Chemicals family and look forward to contributing to its future success. As stated by Dr. Harin, I will take you through the financial highlights. Please note these are all on consolidated basis, and the comparison is on year-on-year basis. In Q2 FY25, our revenue increased by 20% to 193 crores, driven by higher volumes in core business, along with incremental contribution from Bulli Chemical and Neogen Ionics. Organic chemical witnessed 34% revenue growth year-on-year at rupees 164 crores, while inorganic chemical revenue declined by 24% to 29 crores. The revenue of both could have been higher, but for the decline in the raw material prices during the quarter. EBITDA rose by 33% to 35 crores, led by higher plant throughput as well as better operational efficiencies. EBITDA margin remained healthy at 17.9% even in this weak pricing environment, and startup related costs at Neogen Ionics. Profit after tax came at 11 crore, an increase of 38% year-on-year. This was in line with strong operational performance. The increased capital expenditure in battery chemical segment is expected to result in higher depreciation and interest costs going forward. The domestic and export mix during the quarter stood at 74% and 26% respectively. That concludes my initial remark. I will now request the moderator to open the forum for Q&A session.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask the question. The first question is from the line of Abhijit Akella from Q2FY25 Securities. Please go ahead.
Yes, hi. Good morning. Thank you so much for taking my questions. So first, with regard to the capex numbers for the first half, in the consolidated cash flow statement, I think we can see a number of about 150 crores odd. So how much of this would have been towards the battery chemicals segment, and what should we expect on a full year basis for capex for the overall consolidated company? Is it tracking in line with the timeline, given that we have to spend 1,500 crores maybe in less than a year now to commission the Mitsubishi plant?
Hi, Abhijit. Good morning. Yes, the capex that you are seeing is mostly for the battery materials. And while 150 crores is in the first half of it, totally I think we have spent around 350 to 400 crores over last in the battery material space out of 1,500. Some of this was already sitting on Neogen's balance sheet, which was then transferred. So therefore, when you are looking at a console number, that transfer you're not seeing. But in the battery material space, overall, we have already invested around 350 odd crore to 400 crore capex already has done. We feel we should end the year somewhere around 750 crore capex of the total 1,500 crore which we are targeting this year. And then the balance would come in next year. Some of it also, the way we are constructing it, Mitsubishi is constructing the main plant. So that sits kind of as an advance. And they are already started construction on their end, and then the entire plant will be built there and then transferred together. So that's going to be a big chunk which will come in the next financial year once that plant is ready. But from our side, the investment on that is already progressing.
Understood. Thank you. Thanks, Dr. Harin. Also, on the subsidiary revenues breakdown for this quarter, would it be possible to just split it out between Neogen Ionics and BuLi Chem if possible?
So broadly speaking, I would not like to give a specific number because, these are one product kind of companies. But when it comes to what you are seeing, the total difference, I would say the Neogen Ionics is still in single digit crores and the balance is basically from BuLi Chem. But we've seen significant improvement in BuLi Chem, and Q1 and Q2 from a battery material point of view has been more or less similar, single digit crores.
Understand. And just one question with regard to the environment in the US now. I believe the Trump administration had kind of indicated plans to remove the Inflation Reduction Act if it came to power. How do you see the risk over there in this scenario?
Sure. No, so what we have seen and what our experience has been when we've talked to the customer, of course, the discussions with the customers were before like the election results, but there was always this possibility and we had heard about it. The feedback which the customers have given is, look, even if whether there is a IRA or no IRA, we still need this, especially in the electrolyte salt business, because just to have a second backup, because 95% of it coming from China is something which we are not comfortable. So again, they continue to take that view that are you the best source outside China? This is one question. Then the second question which they've seen is that, like I said, if they look at last 4 years with the formula pricing which we have, they would still have been better off than buying at a spot market from China. So these are the two decisions which are there. Separately, they've also commented that so much amount of investment also which has happened in case of related to IRA driven investment, and that too in so many states where there's a very strong support for Trump, that they feel it's going to be very difficult to completely unwind IRA. There might be few variations or changes around that, but mostly they feel there will be some form of IRA with some modifications still continuing. This is the views from our customers, but as far as our investment was going there, they said, Harin, don't stop. We need more, and they are even encouraging us to think of some other molecules also, which doesn't require. So anything which doesn't require a presence in the US, they are telling Neogen, please consider these options. So their interest remains still very high, and recently also we had visits from them, and during the visits also they're satisfied with the progress we are making and given us more confidence to even challenge ourselves to do even more than what we have currently planned.
Got it. And just one last thing, if I may, if you'll permit me, before I get back in the queue. So from a second half perspective of this year, with the salt volumes ramping up, and I'm not sure how the traction with regard to the commissioning of battery capacity is going from the large guys such as Ola or Exide. But in the context of whatever you are seeing, do you still believe that 100 or 150 crores of battery chemical revenue is possible for this year itself, fiscal 25?
No. So for battery chemicals, we had guided for this current year around 75 to 100 crores range. And what we still feel again, it depends a little bit on the electrolyte ramp up, which happens. But what we are seeing is somewhere, let's say, between 50 to 75 crore. I'll be honest, the first 6 months, the approvals have taken longer time for the new site. So especially for some of the salts. So based on that, today what I'm looking is best for this particular year for battery would be somewhere around 50-75 crores. But next year, or the year after, I don't see any change.
Okay, understood. Thank you so much. I'll get back in the queue for more.
Thank you.
Okay, thank you.
Next question is from the line of Nilesh Guhe from HDFC Securities. Please go ahead.
Yeah, hi, Harin. See, Harin, you mentioned that the volume growth was very robust in your core business. My estimate suggests that it is close to about 50% YOY basis. So can you tell me which category of products have shown such a high growth? Is it in advanced intermediate or lithium derivatives, bromine derivatives, or in CSM?
So for us, when you are comparing, we have seen good growth in lithium derivatives, because if you see the corrected numbers, right, we have seen almost a 30-40% increase on the lithium side. Of course, you're not seeing it just because the lithium prices are like 1/3, and even our consequent per metric ton prices are less than half. So as we have given on our slide 20 of our presentation, where we have shared what the number would have been if the prices would remain the same. In case of organic, the main contributor is going to be the BuLi chemicals, because we are just starting with our BuLi chemical plants at that time, and now we are almost running at a full capacity. So that have been the main drivers. In terms of our organic production, right now the major improvements that we have seen is the non-agro CSM that has contributed, and also the bromine derivatives. In bromine derivatives, we have few bromine derivatives which were used in a molecule which was getting approved by the innovators. If you remember, when we did our Dahej site expansion, we said we had signed one long-term contract, a 5-year contract with a pharma customer, where we are going to be supplying them bromine derivatives. But as the molecule gets more approvals, the demand will grow up. So I think that business is improving quite a bit. So I think bromine derivatives is doing a good job. In terms of non-agro CSM, so we had a target to reach around 20% CSM, but last 2 quarters we are already at 15-18%. So we want to reach 20% by next year, but we are already at 15-18% in spite of a lower demand from agro. So the agro demand not being there. So the CSM that we've done for semiconductor, or what we are doing for our flavors and fragrance, and some like specialty polymer and other specialty materials, fine chemicals. That has also done well. Lithium salts have done well. Advanced intermediate, which we basically sell in the generic market, that is still the area, and agro is the other area where in advanced intermediate, the Chinese competition and slightly lower demand in bulk APIs, this is something which is which we need to improve upon. And the agro CSM has not picked up in this year, although we are doing several projects which we had done last year, and we are now the customers will start planning their 2025, especially the Japan customers. They start from October onwards, they are planning. So by January or so, we'll have a demand on Japanese agrochemical demand. So that will give us an idea how that CSM is going to work out. And so we'll get a clarity on that. And the advanced intermediate is another area where we still need to work upon.
Okay. And as you mentioned that July Chemical already reached its peak utilization. So the benefit out of that, as we have the entire chain of a bromine derived from bromine derivatives and lithium derivatives to extraction of lithium technology. So are we getting benefit out of that? That means this salts regeneration of lithium and getting lithium back.
Yes, so we have already started recycling the lithium which comes out, which was being given out externally, and that is helping us increase some of the lithium volumes also. Some of the businesses where we used to have the price pressure, because we are able to do this recycle, we have been able to increase volume, even though lithium prices are depressed, and so I think that benefit is coming. You're not seeing it fully, like I said, because of the depressed lithium prices, but otherwise, that's something which is already helping us.
Yeah, and the second question is on the margin. So we can see that more than 200 bips improvement in EBITDA margin if I compare that with the last year. So is it largely because of correction in product prices, or is there increase in absolute level per kg EBITDA for the products?
So I think largely driven by, this price fluctuation. So last time was a bit lower, right? Because lithium prices were, lithium prices were on a higher side. So on an absolute margin was okay, but per metric ton, the percentage EBITDA was looking a little bit lower. Now lithium prices are also corrected. Last 1 or 2 quarters, even after lithium price correction, there was a lot of Chinese pressure and utilization levels were lower. So as now last 2 quarters, Yuli have been making positive profits. So that's something which is basically helping us. And overall, those were the drags. Even now, battery is still not broken even. We are just into few single-digit crores, as I mentioned, and the expenses are still there with the production and everything going on. So I think we will still see improvement in the margins as you see better utilization levels. But largely it is just the lithium price corrections which are giving you percentage improvement in the margins.
Okay. Thanks, Arun, and all the best.
Thank you.
Thank you. Next question is from the line of Arun from Avendus Spark. Please go ahead.
Good morning, everyone. Thanks for the opportunity. The first question is on the working capital performance during this first half. We have seen a moderate improvement in the working capital. Can you just indicate, is it a seasonal stuff or is it something that is happening? There's a permanent reduction. How we can expect this working capital to further reduce over the next couple of quarters?
Yeah, so we had already targeted that, let's say by next financial year we wanted to reach around 130-140 days of net working capital on net sales days basis. And we are what we are doing right now, we are on we at least, we said, we had done maximum kind of investment which was needed for working capital in terms of inventory, in terms of debtors, and we needed to work very hard to basically improve upon that. So I think that trend has already started, and we'd like to maintain that. Again, every quarter, because we are still ramping up in a very variable kind of a scenarios, we are seeing improvement in our demand, especially in the pharma side, and sometimes they are also coming very suddenly. So we have to continuously keep shifting and adapting ourselves. But I think this will all stabilize, and we continue to maintain what we had said, that by end of next financial year, when we have full utilization levels, we have 1,000 crores, our working capital will also stabilize and go back to historical 120, 140. And beyond that 1,000 crore when we go is when you will start seeing improvement over that, because then we'll have more mature molecules, or CSM business would have stabilized. So we can expect working capital improvement beyond that, let's say in FY25, FY26, FY27.
Right, sir. And this, when we ramp up battery chemicals, should we expect a similar kind of working capital days from that segment? So that means that will drag certain working capital on an overall basis.
So right from the beginning, what we expect, that battery business is a very different business, right? In a sense that we have fewer customers, we have fewer products, we have fewer raw materials, they are dedicated plants. So that's where we can basically engage in working capital very well. The only variable there would be that some of the customers are very large and they would want like longer payment terms. But what we are hoping that with such large customers, we should be able to get like, factoring or like invoice discounting, so some kind of a financial arrangement. So again, this is going to be Gopi's expertise area that we are going to depend upon, wherein even if our customers want a long credit, we can maintain our working capital cycle with a good financial arrangement. But at least from an inventory point of view, what we can say that we can contribute and we can control at around 60 days, let's say 75 to 90 days, so that and hopefully reach a situation where debtors and creditors basically balance each other out. So our target is like a 90 days kind of working capital cycle against 120 to 140 in Neogen's base business. We target like around 90 days for the battery business. That's our target. Again, we are just starting with this business, but this is what we feel we can achieve.
Understood, sir. Secondly, you said that Bewley is kind of already near full utilization. Any chance that we can, the capacity is fungible with the other facilities that we have, and we can make Bewley products given that it seems to be in demand? So can we utilize some of our other facilities and manufacture the Bewley related products there, or still we need to put some kind of a brownfield expansion there?
So, Bewley is a very dedicated kind of very special plant. Because of the hazardous nature, it's very unique. So unfortunately, it's not fungible. The good news, however, is that we can increase capacity at that site. So we have a capacity to grow up to 5 times. We already applied for environment clearance. So we have already received the center's approval on that. Now we are working on the state level approval. And fortunately, with a very small capex, 2x capacity increase we can do, because the site had maintained the same capacity over long period of time, and they had done some cycle time improvements and debottlenecking over time. So around 50% to 100% increase in capacity can happen as soon as we get the environment clearance permissions and the necessary permissions for the increase. So that can happen, and then we would have to do a brownfield to go from 2x to 5x. So that's still like a further view. But I think up to 2x, what we are trying to secure, that now that we've got the center approval, if we get the state approval in the next, let's say 3 months period or so, if we are able to do that, then for the next year, we would have almost like a 2x capacity available.
Right. Understood. So this if you go up to this 2x kind of an approval, would you revise your guidance of 1,000 crore revenue potential for the base business? And if yes, what would be that indicative figure for that?
So for Bewley, depending on the lithium price, as we had indicated, the revenue will be somewhere between 50 to 100 crores on that X capacity, right? So 2X would also be like 100 to 200 crore kind of revenue potential, depending on the price of lithium. With the way the price of lithium is, it's going to be more closer to 100, 125, even at that 2x capacity. So it's not going to change significantly, that 1000 at the max would change to 1050. But with all the other things happening in the agro world, etc., I would like to keep that 50 crores as my buffer, and I would like to still maintain 1000 crores. Let first environment clearance come. Let's see how the agro recovers, and then we'll see next year if we need to revise our projection on the base business. Also, as you might have seen earlier, we had requested for merging Bewley with Neogen. So that applications are also going online, and most likely by end of the current financial year, we expect Bewley to become part of Neogen because it's more similar to the base business, right? So that's why we wanted it to be part of Neogen. So then we would have just Neogen and Neogen Ionics, only two entities. So most likely for the next financial year, it will be part of our standalone results. It will become part of our standalone results itself.
Understood. Fair enough, sir. Finally, lastly, on the battery chemicals, you said in your opening remarks that a few of your customers are going to start the plant. This is in which geography, and also what kind of battery capacity that the customer is putting up on aggregate level? How many gigawatt hour? That will be very helpful, sir.
So, basically when I mentioned that what I meant is that the electrolyte business for India, which is basically, all the battery plants which are coming up in India. So as we know, Ola has already started production and, they are ramping up, as well as few other smaller battery makers with 100 megawatt hour, 50 mega, 250. They are also starting and they are ramping up. And then, of course, Exide and Amar Raja would be targeted at some sort of start and a ramp up in the next financial year. So what I meant was our electrolyte ramp up is basically based upon Ola, Exide, Amar Raja and other battery makers who are planning how that capacity is coming online. So that is the mention. The salt business that we have doing internationally, the capacities are existing there. The capacities are running together into hundreds of gigawatt hour kind of level. Only the question is shifting from China to a Chinese source to a Neogen kind of a source. So that's the shift which needs to happen. So as our capacities get approved, like I mentioned in my call, so some of the basic infrastructure, the quality system, these things are approved. But in battery, there's a more rigorous system where once your process is completely optimized, that is when they will come and do an audit where it's like a parallel audit in front of them. You are doing all the production. So I think that rigorous audit is something which is pending for a few of the clients. And once that happens, then the volumes will start ramping up there.
Right, sir. And post that rigorous audit that you are talking about, after that, again, there will be a few months it will take for us to get the first contract, or is it how does it this process happens?
So many of these, so the contracts are already in place with some of them, right? What is remaining is the PO. So the contracts are there, the pricing, volume, everything is decided. Once you clear all those audits, then the POs start flowing, and that's when you start doing the shipment. So from the audits to shipping time will not be too long.
All right. Understood, sir. Thank you very much. All the best.
Thank you. Next question is from the line of Ankur Periwal from Axis Capital. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. First, on your comment on the plant inspection that we have been seeing. So one, is it for the electrolyte from the domestic players or largely from the salt manufacturers globally, wherein you were commenting on the extended the rigorous audit?
So again, each company has its own, but yeah, both have the same procedures.
Okay, but from a let's say procedural or let's say ramp-up perspective, are we more closer to seeing a ramp-up or let's say product approvals on the salt side, and or how has been your status of discussion with the domestic players for electrolyte side in terms of plant approval and ramp-up?
So I think electrolyte side also, with the 4 customers which we mentioned we worked with, some of them have already taken trials. They have used our electrolyte in their cell manufacturing facility, and some have seen the satisfactory performance. So now they are ready to place like bigger volume orders. There the main bottleneck, I mean, there the main bottleneck is like all the approvals, whatever they need from our side, we are more or less ready. There are some comments or improvements which the customers have requested, which we are basically overcome, which we are doing the improvement like we do in any pharma audit also. So it's a very similar level. It's not something. There the main challenge is that they are also increasing their cell manufacturing capacity, right? Because all the smaller one, the bigger one, they are just right now in the trial production phase. So as their trial production becomes regular production, basically our electrolyte volumes go higher.
Sure. That's helpful. And, you also commented on, the new recipes and the new learnings that you had while working on these trials, with the customers. What exactly, if you can, substantiate that, are these learnings more on the larger number of recipes that you could have done, or it's a new salt or more efficiencies? Your thoughts.
So basically, before we were focusing on how we make electrolyte of the best quality, right? So the process of manufacturing. Now, as we work with more and more customers with different kinds of cell designs, we are getting a more deeper understanding into that for a certain cell design, which electrolyte becomes better. Again, here also we have a collaboration with Mitsubishi where, when a customer wants, we can bring Mitsubishi also together, and then Mitsubishi, Neogen and the customer together help design the electrolyte for the customer. So now some of the customers have already completed their first generation cells, and now they are working on the second generation and the third generation cells. So that is where we are now being a part right from the beginning to help them design what the electrolyte should look like, which will give them the best performance, especially in India kind of a scenario where, India is going to be a high temperature region. So some of the electrolyte designs have to be optimized for India. And we are and in the beginning, everybody is basically trying to make whatever their technology partners were, except for few who design their own. But in the next generation, now people want to design their own unique electrolyte. And we are basically right now partnering with them to basically help them develop those electrolytes. So that's the learning that we had, So if you have this kind of a cathode, you have this kind of a binder, which is the additive which works better or doesn't. If you want to improve charging, what kind of a electrolyte additive can help you, but it will create the other problem there. So depending on what the customer wants, how we can optimize. And again, we also have a Mitsubishi help here where some of the customers we are working together and designing together these electrolytes for them.
Sure, that's helpful. On CSM side, you did mention a target of 20% for next year, and we are already at probably 15-17%. Given that agrochemical is still sort of slightly subdued here, and you mentioned you have got good traction from other sectors, can this growth be slightly more front-ended, or maybe the ramp up in this business could be sharper? And secondly, from a capacity perspective, where are we in terms of ramping up this business to may not be even 20, maybe even higher number from a growth perspective?
Sure. So see, when I'm 17-18%, but that's on, let's say, a run rate of around 200 crores, right? So when we are at 1,000, first of all, that becomes 250, and that itself is like a 25% growth, right? So you still have to grow this business by 25%, and then also another, to catch up on that 2 to 5%, you would need still another 30-35% increase over what we are doing today just to meet our target next financial year, right? So I think we have already a capacity of that. And I think we've shared earlier that we feel with once we reach the full utilization level with some debottlenecking, this site itself can, our existing capacities together can give us still 15-20% more, with a better utilization of all the assets. So we might have to do some debottlenecking capex kind of thing, but we feel FY26 we can be at that 1,000 crore, and FY27 the base business can be somewhere around 1150, 1200 crore kind of revenue. We'll give you a more exact number next year, but this is what we can target, and we'll see. Right now, the way I am seeing it, because till we see light at like how the advanced intermediates in the generic space plays out, we want to just basically see, okay, our better CSM numbers is just a backup for advanced intermediate. Because from a chemistry point of view, that advanced intermediate, which is a multi-stage chemistry, and the CSM, which is also a multi-stage chemistry, that basically like is kind of like fungible, like reactive capacities is what we are basically using there. So we'll use it as a backup. But what I feel is that with the slowness of the agro, and like for us also to understand the semiconductor and utilize our capacities fully, we would also like, if we are in a position where we have too much of capacity, like too much of demand and less capacity, we would also like to optimize our product mix also slightly for better margin or better working capital cycle. So up to FY27, unless something dramatic comes, my view is that I want to focus more on stabilizing this business, making it more efficient from margins, working capital, product mix point of view. And then FY28, 29 is where, all the work which we have done in this will basically allow us to the kind of rapid growth we are seeing in battery. I don't know the same level, but like the long-term view of the CSM to, have single customer who can give you significant hundreds of crores kind of revenue kind of business. So that's something I'm looking at a ramp up happening from FY28 onwards, right? And by that time, we feel battery also would have stabilized. So from a bandwidth point of view, from a cash allocation point of view, we see the rapid growth in the battery in FY25, 26, 27. And this is the time where we stabilize our base business. Bewley gets completely utilized, even hopefully the 2x capacity. The synergies of that start playing out. And based on that, with like the agro, pharma and the other industries like semiconductors, aroma, CSM, we'll see where we are adding most value. And then we use that particular customer or that particular industry as a focus for further growth in the base business beyond FY27.
Yeah, thanks for the detailed answer. Just if you could remind us, FY26 our target was 20% CSM share. What was the same number for 27?
27 we have not. I mean, because like I said, we had so far said only 1,000 crore FY26. So 27 is just debottlenecking to, let's say, becoming 1150 to 1200 crore using the same capacity is what we are targeting. Let's say right now, let's just keep 20% as a target, what we are keeping. The main CSM push or significant move will happen when we set up specific plant for a specific molecule, right? So once your single molecule is like 150 crores, 200 crore, you can have a plant one single plant which is doing only one or two molecules kind of an MPP. Right now, our one single plant is doing like 30 products, 40 products. So we want to basically move on to like 100 crore plus kind of molecules beyond FY27. So that's what will basically drive the CSM growth beyond that.
Sure. Just two bookkeeping, if I may. One on the pricing on lithium and bromine. While year-on-year front, obviously there is a decline. Even on a Q-on-Q front, there is a further dip, or prices are largely stable now?
Mostly stable. I think bromine little bit started forming up a bit. Lithium is like, I would say within that $0.50, like 1 month $0.50 less, $0.50, $1 less, $0.50, $1 more. So like little bit like, just in that noise level, but no strategic shift or change in lithium. But what we know is this is historically lower. A lot of lithium miners are consolidating or deciding their strategies going forward. What we are